All right, good morning everyone. Joined by Brett Shadow today. I'm Tony Davison, of course. Brett, great to have you along, mate. It's good to have you here in Sydney with us.
It's good to be here. It's a little bit muggy.
Yeah, it is, isn't it?
But I've missed out on a 38-degree day in Adelaide, so...
Well, pick your poison, so to speak, isn't it?
It's nice and air-conditioned in the office.
It is. Great to have you here today, Brett. So, folks, what we're going to be doing today is running through our video and also talking a little bit about getting you guys ready for 2020. Now, just before we launch into things, just a really important set of acknowledgements, folks. This is general advice. Now, general advice in our world simply means this is not tailored for you. It's not specific to your affairs, doesn't consider your needs, goals and objectives. And very importantly, folks, we do always allude to strategies and ideas in our discussions, but please note they're not customised for you. Really important one.
It's something you could find on Google if you knew what to search, but it's general in nature only.
Absolutely. All right, now 2020, Brett, we're finally here. It's good to be here. We're going to be talking about markets today, some fairly unusual things going on out there. We're going to be talking about Centrelink. I'm going to today turn the table a little bit. I'm going to ask you some questions, Brett.
Fantastic.
Our Adelaide team, for those who are more familiar with, I suppose, the Sydney operation, our Adelaide team are expert in all things Centrelink. So I'm going to use Brett's knowledge and experience to talk me through a couple of things I always wonder about, and I think our clients should be asking us about in our review meetings as well.
Yeah, absolutely. And the good thing about Centrelink is even if you don't qualify, some of the questions that you need answers to around the Centrelink discussion impact on other areas, such as estate planning, income, that type of thing.
Absolutely. All right, and we're also going to be talking about tax. I'm going to introduce 5 top tax strategies today from Aslan. Aslan, unfortunately, is not feeling well today, wasn't with us, but we are rolling out a series of videos with Aslan and I talking about these tax strategies. I'm going to introduce them to you today, and you're going to get a lot more detail over the next couple of weeks. So, folks, with that in mind, we're just going to kick off a little bit with markets. Now, markets in a nutshell, Brett, are going to be very different in 2020 to where they were in 2019. 2019, we talk about it being an exceptional year. It was a great year for returns for clients, but it was exceptional insofar as really it was an almost uninterrupted year of positive returns. There were very few negative months along the way, and that's pretty unusual. So I'm going to talk in a couple of minutes, next few minutes, about why 2020 is going to be different. But in summary, volatility like we've started to see emerge only since last Friday night in the United States. The share markets have fallen a fair bit on concerns about the coronavirus issue emerging out of China. This is the sort of thing that you're going to see a little bit more of in 2020 that generally wasn't that prevalent in 2019. Now, Brett, just in terms of portfolios, we'll talk about this in just a moment, but I often think about where clients should have their money and how they should be positioned and that sort of thing. Just thinking very briefly about Adelaide versus Sydney, and when you talk to your clients about portfolios, how do you guys sort of characterise the type of investments they should do?
It's interesting. It's always probably the heart of investing, but it's not paid the attention that's probably due. And starting with someone's risk profile, it's generally like politics. You don't generally change your views, and so if you are an aggressive investor or a conservative investor, you can't sort of look forward to the next 12 months and say, oh look, I'm going to choose to be aggressive or conservative. So just catching up with somebody again and just making sure that their position hasn't changed and they're not being influenced by the news cycle, the 24-hour news cycle.
And that's a really important one, right? So we've got the coronavirus concerns in markets at the moment, and that's an interesting one because, of course, no one knows, and we certainly hope it doesn't turn into anything sinister. But the sell-offs that we get each time we have these potential pandemics emerge in markets is almost the same. Certainly the last 5 events, whether it be SARS or whether it be swine flu, the same sort of thing happened when there's great uncertainty and no one really knows what the ramification is, and certainly none of us hope it's going to be significant, but markets sell off. But subsequently, interestingly, each time it's produced an opportunity because, of course, the virus concern didn't emerge as something threatening or long-term. So with this in mind, I had a chat with one of our investment committee members late last week, before the whole coronavirus thing happened, a guy named Andrea Ciaccio. I'm going to try and say his name properly, but Andrea is a senior portfolio manager, an Italian guy who sits in our Hong Kong office and heads up a fairly big set of funds for Azimut, who are the parent company of Pride Advice. Now, as part of our investment committee, we like to think a bit more broadly. And so Andrea's the guy that we often go to for some of our macro thinking. And he gave us some thoughts about 2020 and some of the prospects for the year ahead. Andrea, good to have you along today.
Thanks, Tony. It's great to be here with you today.
So, Andrea, there's a lot of questions about markets at the moment, but let's get to the nub of it. Share markets keep going up. Why do they keep going up?
Yeah, that's a very good question. I would say last year we had a lot of uncertainties because of trade war and because of Brexit. Then you got basically Trump and China signed the phase one deal. Boris Johnson had a massive victory. And so essentially you have these risks that have been removed. So now the market is happy and is looking positively to the future. That's one factor. Another important factor is that normally in January, you have investors, like the big investors, like pension funds. They make a decision about the year. What they're doing is basically they are increasing their allocation to equities. And normally, they would do 30 to 50% of this increase in the first 3 months of the year. So basically, they are continuing to buy and pushing the stock higher. And the last factor, which I think is the most important, is that if you remember, beginning of 2019, the Fed, the US Central Bank, was supposed to hike. Now we are at the beginning of 2020, and the Fed actually has cut rates 3 times, and is increasing the money again, is putting money again into the system. So it's completely opposite scenario. So central bank is very accommodative, and market, as I say, they are really happy about that.
So, Andrea, does it render the share market expensive at these levels? I mean, we keep pushing all-time highs in the United States. Australia's hit another all-time high, replicated in other markets in other parts of the world. Is it expensive at the moment?
Yeah, I would say yes. The market is expensive. If you look at many metrics, in historical terms, is expensive. And the reason is that, yes, we talk about macro, meaning what's happening with the central banks and everything. But we have to remember that at the end of the day, the valuation of the stock market depends on earnings, meaning companies have to make money, right? So what's happening is that last year in 2019, we had a very strong rally in the market. Market went up 20% plus. But company didn't increase the amount of money that they made. They made essentially the same amount of money that they made in 2018. What that means is that the stock market today is 20 to 30% more expensive than it was last year.
Wow. Okay. But
so of course, last year we had more risks. We have more risks, and now we have less risks. So what's happening is that the market is thinking that because we have less risks, earnings eventually will catch up. But we will have to see.
But that's the thing, isn't it? If it's 20 to 30% more expensive and markets are now stretched to the upside and expecting earnings to catch up, what happens if earnings actually don't catch up, particularly in the United States?
Yeah, I agree. That's a very good question. When you say I agree with particularly in the United States, because I believe that's the place where I see the highest risk of earnings disappointment, and also the highest risk, if you ask me, in terms of disappointment in terms of growth, because people expect the US economy to continue to be the strongest, but our base case is that actually US economy is slowing down.
So what's your outlook for returns in 2020? Are we in for another big year like we did last year, 20 to 25% for the share market, for instance, or is it going to be a different year this year?
Well, I think it's going to be a different year. 2019 was definitely an exceptional year. So we did some research, and in post-war environment, when you have such a strong year, calendar year, normally the following year you still have the market going up 5 to 10%. That's most likely because, as I say, there is momentum. As I say, people continue to allocate, and everybody looks very, very, very positive. So this is our base case. I think 5 to 10% could be something that is achievable this year. But as I say, we really need an improvement in earnings and the economy. So we need a confirmation that these things are going to tick up now and not continue to flatline or going lower.
That's a really good summary, Andre. I really do appreciate your time and wish you good luck over there in Hong Kong with all the things that are going on at the moment as well. And hopefully we're going to talk to you a bit more in 2020. Thanks for your time.
Thanks so much, Johnny. Thanks
Thank
for
you.
having me.
It's interesting, Brett, when we talk about the risks that are out there at the moment. I'll just sort of summarise them. And it's worth noting too, we're not bearish or negative about markets. You know, as Andrea points out in that video, you know, most years you have a rally like last year and then you get follow on the following year. So you still get positive return. But we do have some concerns, and the things that we're watching at the moment are obviously these stretched valuations. The market's gone 20% plus higher, but as he points out, company earnings haven't. And really fundamentals sort of drive those things being company earnings. The second thing that's I think is probably the big one that I'm really myopic about is cheap money. You know, cheap money is the thing that has fueled the fire last year. There was particularly a couple of things that happened in September last year I won't bore everyone with, but essentially central banks really stepped in and supported markets, and they haven't stopped supporting markets, and that's really fueled things along. The other thing is we've got all of the figments too of markets that keep going higher, which are really buoyant optimism. You know, we have sell-offs, but they're punctuated very short term, and as a result of that, it sort of signals to us buoyant optimism. And of course, we've had the resolution, as it were, of a trade deal, a stage one trade deal with the US and China.
Yes.
But markets are telling us already that they don't think that there's a huge amount with it. And the last thing I think is just very quickly, yes, there's a US election later this year. That is going to be a big deal for markets in our view, and that's something we're going to be watching very, very closely about, particularly after the Democratic nominees start to become prevalent or aware, around about March or April, but it's possible it may not actually be resolved until the Democratic convention mid-year. So in other words, there's a bit of market uncertainty around whether or not Donald Trump gets re-elected, and that will become more prevalent as the year goes on. But that having been said,
Fascinating.
we're still in an era of cheap money, and we have economic growth that continues. So as a result of that, we still think that where you do get these sell-offs like we have today and at the moment because of the coronavirus, they are largely going to be a buying opportunity. And so for 2020, the reason that markets are quite different, folks, is that it's going to suit agile investing. It's not to sit back and just let things run as we could have done last year. We certainly didn't. It's an opportunity to sell high and to buy low and to take advantage of certain sectors, as I'll just quickly talk about in our portfolios. Now, folks, this is for the year ending 31 December 2019. It's so important to note the figures are indicative. They come to us from a platform, so a third party tells us what the returns are, but it reflects a general portfolio. It doesn't reflect every specific portfolio, so please use the numbers in here as a bit of a yardstick. But AZ Sustante, which is the Pride portfolios, they produced around about 18.5% for a balanced portfolio for the 12 months through 31 December. So again, we're still expecting reasonable returns in 2020. We expect the themes, though, will be quite different as we start to, as the year unwinds, move a little bit away from the cheap money story back into things like commodities and some of the inflation hedge products, and also start to position for a bit more of potentially some inflation and political risk at the back end of 2020.
Just for those that don't understand the comparisons that you've got there on that balance performance there, you've compared yourself with Innova, Morningstar and Lonsec. Now these are fairly large research organisations that their similar balanced fund has performed to that extent. So,
in summary, folks, still expecting reasonable conditions, but 2020 is just going to suit investors who are prepared to make quick decisions and be agile on their feet, and certainly the investment committee and I are focused on that this year as well. Brett, I want to turn the tables just for a couple of minutes now. I think whenever a client comes in for a review, the advisors, we all do, we spend a fair bit of time preparing for that meeting, thinking through the issues, thinking through the overall strategy for the client, but there's an opportunity for clients to come to us with their questions. Now, you guys are experts in all things Centrelink, and it's a really important facet of the financial planning process for all of us as planners. So I wanted to ask you a couple of questions about this, given your expertise. And the first one I got is, when should a client start talking with their advisor about preparing for possible eligibility for Centrelink benefits, whatever those might be?
I'm going to take a leaf out of Aristotle's book and say it depends.
Yep, right.
Now, the rule of thumb would be that we're talking to our existing client base, but you would think at least 5 years before getting to pension age, because it's at that point that we can start strategising with the rules as they are now, and maximising through those strategies what they're likely to be. And one of the reasons 5 years is important is because of the excess gifting rule.
Yeah, okay.
So if you do have a lot of asset, and you were thinking of gifting a house to the kids, an investment property, or doing something along those lines, then you can only do $10,000 a year or $30,000 over a rolling 5-year period.
Yep.
And whatever is considered an excess will hang around for 5 years.
Okay.
And you need to report that to Centrelink when you apply. Whereas if 5.5 years out from pension age, you were to gift an asset that you were going to do anyway, then there are benefits to doing that. So the sooner the better. And if you've got friends or you've got kids that are approaching that point, the sooner they engage with a planner, even if there's not an ongoing relationship at that point, having a conversation and working out what it is they need to be considering 5 years before getting to pension age, really important.
Okay, that's a good one. So if we're 5 years away from retirement or pension age in particular, I mean, obviously, and do check also the Department of Human Services website for the age at which you become eligible for the age pension, because it's no longer a generic age, is it?
No, it's pretty much 67 now.
It pretty much is. All right, the second one, Brett, I want to ask you just the highest level. This is a scheme that most people don't know about. And in certain situations, I think where clients have a situation where they're cash poor but asset rich, the age pension may be partly accessible, but the pension loan scheme might be able to be a top-up. What's the scheme?
Look, if I think of Centrelink as a human body, I see the pension loan scheme as perhaps the nail on the little toe.
Right.
In its current format, it is definitely there, and it's something that can be considered.
Yep.
And effectively, if you have, in that example, a house worth a couple of $1 million and very little else, you might be getting full Centrelink benefits. But maintaining the house and the costs associated with council rates, water rates, those sorts of things, might be eating into your affordability and being able to live the lifestyle that you want. So you can apply and get up to 1.5 times your fortnightly age pension and as additional income. And that lump sum will accrue up to a maximum depending on your age. And there is an interest rate on that outstanding loan of about 4.5%. And so if you wanted to go down that path, you could, which is an alternative to perhaps the costs associated with selling your house, downsizing, and realising some more equity that way to be able to live a life you want to live.
Now, it sounds a lot like a product that most advisors regard as extremely nasty, which is reverse mortgages. Yeah, so it's one to maybe ask your advisor about, know that it's there, but from what you say, the nail on the little toe analogy there, Brett, it's something that's really explicitly, suitable only for a very small proportion of people.
And if that little toe, if you stub it or if you get an infection, it becomes very noticeable. And there are some reviews going on with the government at the moment around to your own in around relation to your own home and its value and its current non-assessment towards the age pension, but its potential assessment in years to come. And as planners, we're always planning for the future, and that little toe could become quite problematic for some people, and it might be that it becomes more at the forefront of our thinking down the track.
All right. What do we always say? Get advice.
Yes.
So, next one, the seniors health card versus a pensioner discount card. I often quip to clients, you pretty much have to be James Packer not to be eligible for the senior health card. But there is a difference between the two cards, is there or is there not?
Look, very little difference nowadays. Roll back 10 years and people would do anything they possibly could to qualify for $1 a fortnight of age pension to get that pensioner concession card. But understanding that the governments have changed it where there is a hairline in between the two now. I wouldn't say that it's material.
So it covers things like pharmaceuticals, medical bills and so forth, but what you're saying is there's not a huge amount of difference between them?
No, not nowadays. We've got to be a little bit careful though, because the eligibility for a Commonwealth Seniors Healthcare Card means that you're not entitled to an age pension, but there is still an income test. It's about $56,000 for a couple and $90,000 for a couple, $56,000 for a single. But it's not. It's your adjusted taxable income and deeming on an allocated pension that was commenced after the 1st of January 2015. So even when we're trying to perhaps consider changing or refreshing someone's existing allocated pension, if we went and moved it to a different product for some fee savings, it might actually knock them off their Commonwealth Seniors Healthcare Card So as a result, we would have those conversations. So look, we could save you a $1,500 in ongoing annual fees, but you're going to lose your Commonwealth Seniors Healthcare card, and that's really important for some people.
All right, and folks, that's something we call grandfathering. If you
Yes.
ever hear an advisor talk about grandfathering, what Brett just said there, critically important, and it's actually one of the greatest trap holes out there. It's something to be so careful about because it really can make a hash of your Centrelink benefits, can't it, if you get it wrong?
Absolutely, particularly for unadvised people that have an old allocated pension and decide that they will move it and they don't know the implications.
Yeah,
Really important to get advice.
absolutely. All right, last one. Centrelink, being a government body, all governments at the moment are quite hungry for revenue. What happens if you don't update Centrelink? Say, for example, simplistically, you come into some money, say it's inheritance or, a small lotto win, call it 100 grand, something like that. Not that often happens, but, what happens if you don't update Centrelink with the details?
You've got 14 days to notify Centrelink of any material changes, and so it's a little bit grey in terms of what is material, but you do have an obligation. So irrespective of what that inheritance was, it works equally if you spend money as well. You should be letting Centrelink know straight away, but if you are getting more than you're entitled to based on a change of circumstance, then they can do a review and a look back, and you could have an outstanding amount they would want to negotiate repayment of.
Yep.
Their starting point would probably be to repay it in a lump sum,
Yep.
and your starting point would probably be to repay it as $1 a fortnight off your current pension, and it would depend on how those negotiations went. But I think to be safe, you just don't want to ever be there.
Just keep them informed.
Keep them informed.
No problem is a good problem, yeah.
And as the advisor, we can only tell Centrelink what you tell us.
Yeah.
So if you make the call to not let us know about an inheritance or some money you've got buried in the backyard, I'd suggest don't do it. But we can only let them know what we know.
Absolutely. So, Brett, some good stuff in there, and folks looking forward to receiving some of those questions when we catch up in
Fantastic.
our reviews. And your advisor's a great portal for some of these things. Before you go to a review, think about the things you want the advisor to tell you, and some of these things are critically important.
And in relation to Centrelink too, it's really interesting. Just because you weren't entitled to Centrelink when you first retired, 10 years down the track, if you've used up some of your capital, or if there's been a share market correction and the value of your assets has reduced, you may be entitled. But
Totally.
people don't understand that.
No.
So we have people coming to see us at 75 that suddenly are entitled.
Yep.
They thought they weren't, and it's a great thing.
Yeah.
We go do the applications and they're right.
Absolutely agree. No, totally agree. We'll stay on top of that. Now, folks, we're just going to turn quickly to top tax strategies. Now, tax planning time really starts now. For an advisor, it never stops, but really for those who are conscious of a windfall or an opportunity, you really want to jump onto this. Now, Aslan's not with us today. Aslan's our accounting partner. You see her from time to time on video. She's not well today, but we're rolling out a series of videos which you're going to see in the Lions Roar, which is our newsletter that generally goes out every couple of weeks. You're going to see these themes coming through in the next few weeks, and I just want to quickly introduce them to you. The first two, really, Brett, are around a situation where couple, have actually come into a capital gain. Now, this might be from selling shares or selling a property, but you'll see this coming up in one of our upcoming pieces, where essentially we plan out a situation where people can reduce the liability on the capital gains tax by contributing money to super. But importantly now, the rules have sort of changed a little bit with some introduction of new legislation a few years ago. Previously, to do some of these things, you needed an SMSF. But the good thing is that these days, you don't need an SMSF and what we call contribution reserving. You can also do it just as an average person through a normal super fund. Now, as things carry forward on this particular strategy, which will be fleshed out in this video I'm going to do with Aslan, you're going to see how it's possible, well down the track, for someone to potentially use unused super contributions of $125,000 to offset a capital gain. Uncoded, what this just simply means is there is the opportunity with some good planning in advance, using some of these rules to reduce a capital gains tax obligation. So they're the first two. If you do have a capital gains tax obligation, you're aware you've done well, you've sold a property or something this year, talk to one of our accountants at any stage, because planning ahead for these sorts of things gives a great opportunity. The other one is downsize a contribution. Now, this, Brett, I reckon, is probably the most practical, intelligent, obvious, might I add, pieces of new legislation that have come through in the last 5 years for super. But in summary, a couple between them, if they've owned a property for more than 10 years and they're over 65 years of age when they sell the property, can arguably contribute up to 600,000, 300,000 each to super.
Given the baby boomers are in the retirement phase now, and considering other alternative options like retirement villages and independent living, absolutely.
Yeah.
So there's something that's not considered a lot.
It is. And the other thing very quickly on this strategy that I like about it is it allows people to materially change the phases of retirement. In particular, when you sell the home or when you start to tap super to replenish or pay down things like debt. Some really good strategies in that one.
Sure is.
Two others very quickly. For small business owners or people who are running small businesses or sole props, we still have until 30th of June this year the $30,000 instant asset write-off. Now each budget, the last 4 budgets, has been extended for another year, probably will be for this one, but do remember that if you have an opportunity to buy a piece of CapEx for the business, you can write that off instantly and that one continues. Second last one very quickly, this is an important one. This is a really interesting one. We've been talking a bit, Aslan and I, about expatriates and the impact for expatriates about some of the recent tax changes, but there was one that was introduced late last year which has an implication if any beneficiary of a trust lives and works overseas as a non-tax resident. So for example, let's say you have a family trust and say one of your kids is living and working overseas, there may be additional land tax and stamp duty charges associated with your trust that you're not aware of. Now, some simple changes can actually stop these taxes. They were actually they were introduced and effective from 31 December, but nonetheless, despite being retrospective as we call it, there are still some opportunities to manage for this one. So in summary, if you have a family trust or a discretionary trust or a unit trust, doesn't matter, any trust vehicle that holds a property and one of the beneficiaries or unit holders of that trust is someone who lives and works overseas, please give us a call. This one has massive long-term implications for those trusts that are affected by it, particularly, as I said, people with kids who are living and working overseas. You don't even realise until you get the bill that you're obligated to it.
Or if they're considering going to travel overseas to actually work, and you've caught up over Christmas time and they say, guess what, Mum and Dad, great news, I'm off to the UK, I've been given a job, and there's some stuff you need to be considering.
Always planning ahead, isn't it?
Yep.
All right. So folks, it pretty much wraps it up for today. We always like to keep these fresh and quick. But in summary, over the next couple of weeks and months, you'll see some of these themes coming through the Lions Roar. We will be talking about Aslan's tax strategies. We'll be seeing those through in some of those articles that I showed you there, and also some videos that we're going to prepare. We're also going to be having a look in the next few months about self-managed super. You know, a lot of funds out there that are not used to their full extent, and you've got to ask the question really, you know, should these people still be in self-managed super, or are there now alternatives that can achieve the objectives that they want to? So we're going to be talking about that.
Yep, very topical.
Absolutely. We're going to be talking also about equalising super and balances for female members. It's a well-known fact.
Yeah, absolutely.
Females come into retirement with far less than males.
And it's a big strategy for us to equalise purely from a Centrelink point of view in terms of assets and things like that as well. So
yeah, good point.
There's so many things that make this worthwhile.
Definitely. We're going to be doing estate planning, always a good one, so important, but particularly going to focus in estate planning on the documents that help people while they're still alive. It's not all about a will and testamentary trust.
Had a great example last week. They're very, very important.
Oh, really?
Yep.
Okay. And also franking credits. It's obligatory, but it's worth doing some planning around March or April to maximise your franking credits while we're still inside the 90-day hold rule.
Yep.
A tax thing we'll come back to a bit later on, but folks, that's a good summary. So, Brett, thanks for your time today. So we covered markets. I've asked you some good questions there about Centrelink, which is fantastic. And folks, we've introduced 5 top tax strategies, which we're going to flesh out in the Lions Roar over the next couple of months. So you'll see that coming through. So the last thing to do is just remind you again, it's general, not specific today. Don't do any of these things without seeking advice first. Give us a call or talk with one of our tax agents before doing anything. And Brett, thank you for coming along, mate. It's great to have you here.
As always, you drive the car very, very well. Much better. I love being the passenger. I've got no idea how you do that stuff. So thanks for having me.
Thanks for coming along, Brett. Well, folks, wishing you well for a good start to 2020, and we'll look forward to seeing you online again very, very soon. In the meantime, any questions at all about anything we covered today, come to your advisor, come to Brett or I, drop us an email. We do like to hear from you, and we'll look forward to seeing you again in a couple of weeks' time. All the best.
Thank you.
Thanks.